All right. Good afternoon. Today we're talking about HELOCs, and we're going to just explain some basic principles about them so that you can get a good feel of whether or not a HELOC is a good fit for you. So, my name is Jordan Johnson, and I am the host of Couples Create Cash Flow, a channel that is dedicated to helping couples and individuals invest in income-producing assets to create monthly income that will help pay the bills, but also maybe help invest in more assets until you get this snowball going where you actually have your assets pay for your monthly expenses, in which case you become free from any debt or even the need to work. So today I'm going to talk about HELOCs because I use a HELOC in my velocity banking strategy to pay off my debts fast and also invest in the future. So here we go. Just a quick overview. What is a HELOC? A HELOC is a home equity line of credit, and banks will typically lend up to 90% of your loan to value, which means if your house has a value of $100,000, they would loan $90,000, right? So obviously you multiply that by however your home value would look, and you get your maximum value. Now, they also look at what you have for a mortgage. So you have to put together the loan value of your mortgage as well as the value of the house and kind of see what that offer is. So if they're 90%, so let's say in just $100,000 example, $90,000 would be the maximum that they'd be able to lend up to. But if you had a $60,000 mortgage, that means you have a $30,000 window between $60,000 and that 90% LTV. So they'd be able to offer you a $30,000 HELOC. All right. Typically, the interest rate for the HELOC floats, although sometimes you can get an introductory offer that would allow the interest rate to stay fixed for a specific amount of time. A lot of times there's a 10-year draw period, and then it goes into more of an amortized payment schedule. And the interest is actually figured out on a daily balance basis, like a credit card, not a fixed amortized schedule like a mortgage. So what that means is, unlike a mortgage, which has a fixed monthly payment, and HELOC actually only has an interest payment. So what they do is they look at each day, they look and see how much your balance was, and they multiply your balance by the average. So not the average, I'm sorry. They look at your interest rate for the entire year. Let's say it's 7%. They'll take 7% and divide it into 365 equal portions. And they'll take that tiny little sliver and they'll apply it to that daily balance. They'll do that for 30 days or 31 days if it's a month with 31 days. They'll actually add all that up into one monthly fee, and then that is how much you pay in that month. So the idea behind the strategy called velocity banking would be, because you are able to only be charged the balance or interest on whatever balance you have each day, the more times you can input money into that HELOC, or the fewer times you pull money out, the lower the balance you keep in it, the less interest you actually pay. And so like with your mortgage, you'll have one monthly payment, and so there's nothing fluctuating throughout the month. You just make your one payment, and then you make your next month payment, and in between, nothing happens. It's very static. So you'll have one payment, it'll drop, and then it'll be static. With velocity banking, you might get paid on the first of the month, and you might have some expenses, and then you might get paid on the 15th, and then you might have some expenses. And so your balance is constantly going up and down. And what ends up happening is you can actually pay less interest just because of the fact that you are not getting charged for interest if you don't have a balance on that specific day. All right. So velocity banking and HELOCs in general, the most important thing is that they make your, let's go back to this. Makes the equity in your home liquid or usable instead of frozen. So what I hear a lot of people say is, I'm going to pay off my house, and that way I will be more secure financially. And there is a chance that you will be. However, the problem is, once you start paying off your house, you owe less and less to the mortgage company. However, you do actually increase how much money gets frozen in the equity of your home. So you might have a lot of value or wealth built up in your home, but not actually able to tap into it. And that's a problem. All right, so Velocity Banking says, how about we take out a HELOC and leverage the funds that are available through that HELOC to pay large chunks of money towards debt, and we're going to put our paychecks into it in direct deposit so that we reduce how much we owe as soon as those deposits are received. The other thought is we can do this 12 months at a time, right? So if I have an idea of how much I'm, clearing each month, how much my cash flow is each month. Remember, cash flow is income minus expenses, what you have left over, right? If I take that leftover number times 12, that would be the maximum amount that I could put towards paying off a debt. So for example, if that 12-month chunk, let's say I have $1,000 available to me every month, that'd be $12,000 in a year. Let's say I have a HELOC that's $30,000 of spending limit. I could take 12,000 of that and apply it towards a debt. Or I could take 12,000 of that and invest it in a house, or invest it in a stock, or invest it in something that brings me a return. Then I can use that return to help pay back the debt. The 2/3 rule says it might be good to keep your limit on your HELOC to about 66% as the max, so 2/3. That way you can keep your credit score good. You're not borrowing up into your limit. And you also provide yourself with a little bit of buffer in case you need some savings. Now, where do you get a HELOC? Most of the time, your normal mortgage lenders are not going to do this, so you have to go to a credit union. And the one I use is Truestone Credit Union in the Twin Cities of Minnesota. And, to be honest, it was super, super cheap. I think there was like a $99 startup fee and then an appraisal, which was $400 to $500. The other thing is I actually got an appraisal done with this computer program where they didn't actually have to send somebody out. That was actually this most recent one I got, didn't even need to pay an appraisal fee. So sometimes you can get it done pretty well as long as you have good credit. You also have to kind of get a relationship built up with the bank that you're going with. All right, so one thing that you want to look at is, does your HELOC have an online banking app? It's really nice to be able to transfer funds between accounts within your bank. The credit union I actually have a savings account, checking account, credit card, and a HELOC all on the same account. And what I can do is I can go on the banking app and I can transfer funds between those 4 things anytime I want. I've got my paychecks getting direct deposited. So immediately once it hits that, it reduces my daily balance, which would reduce my interest that I pay. And if I have to, I've got a credit card through them. So if I spend on the credit card, I just use my HELOC to pay off the credit card. So it works really well. It gives that delay between when I make a purchase and when I actually bring that money out of the HELOC and incur that balance, the interest payments on that balance. All right. And then it's good to be able to transfer money between the accounts and to not have any restrictions on how you withdraw funds. Sometimes certain credit unions, you're going to have a certain amount of transactions that you can have per month, like 4 or 5. And I really wouldn't be able to function very well with that particular restriction. Or it may say that you always have to keep a minimum balance of like $10,000 on your line, which would be okay, but it would be restricting if you really wanted to pay it off and get down to almost nothing. It'd also be nice if it functions like a checking account. Should have a routing and account number, just like a check. Mine actually does have physical checks that I can write to spend that money. And I've actually heard of some that come with a card, so you can spend with it online. So here we go. How do you start? You got to think about, is Velocity Banking with a HELOC a good option for you? And the answer is complicated, but in a lot of cases, the answer is yes. If you have a home and you have some equity in it and you have a good credit score, typically above 700, and you can find a good lender in your area, that's usually a good fit for you. You also need to know, are you the type of person that can handle having extra money available to spend, even if you come across something that's really, really cool and it's not at all an asset? You don't want to be going out there and doing impulse buys with an extra $30,000 at your disposal. Sometimes those can be really expensive toys. So you want to make sure you don't invest into something that's going to go down in value, or also something that can't bring money back in cash flow, which would allow you to pay down the balance of your HELOC. The whole purpose of this would be using cash flow each month, the difference between your income and expenses, to lower how much you have in your HELOC, so that by the time you get done with those 12 months, your balance gets down to pretty close to zero and you can start again. All right, so last thing with this video, I am offering a free guide on how to get started with Velocity Banking. Super simple, just 3 easy steps. The guide is a download, so all you need to do is follow the link in the description below, and you'll be able to get access to that guide for free. The only thing I ask is that you join my email subscription so that I can keep sending you more deals and let you know when I post new videos. That's it. Otherwise, the guide is free. So thank you for watching, and I hope that this helped. Please let me know in the description or in the comment section if you have any questions. All right, that's enough for now. Talk to you later. Bye.